What's going on? My name is Michael Ducil. So today my intention is to teach you a little bit about some wealth secrets that I learned through trial and error and just really trying to figure it out. Let me tell you a little bit about me. First and foremost, I am Michael Ducil. I am the founder of the 1% Mindset. And when I first started the company, it was to equip young entrepreneurs with the necessary principles to perform at elite levels in all areas of life. And I've been fortunate enough to transition it into a youth program where I have my signature program, Leave a Legacy, which is an entrepreneurship program, and my financial literacy program that I believe has been paramount and instrumental in teaching young people the importance of financial literacy and what that looks like. And to be honest, my thought process really came when I was in college. And I want to tell you a little bit about this story because I think it's important to show the transition and understand why I even got into this business in the first place. Back my freshman year of college in 2006, I remember my first roommate, a Jewish guy, his really good brother. I had a lot of fun just learning about his background and learning from him. And I remember he came to me and he always had all the new things. And look, to be honest, I came into school, I didn't have much. I was getting grants and loans and stuff like that. And I spoke to him, I was like, man, it must be nice you don't have to work. And he told me, he said, look, man, I've been fortunate. My parents, they put a life insurance policy on me for when I was a baby and they just kept putting money into it. So now that I'm in college, I have access to that money. And I was like, for life insurance? He was like, yeah, it's a cash value life insurance that I had. And that's what he told me. And I was like, oh, cool. I didn't think nothing of it. All I knew is he said he had about 80 to $90,000 that he had access to if he needed the money. And in my head, I'm like, oh, must be nice, right? And I didn't think much of it. But looking back on it, the fact that his parents were able to put a policy on him as a baby up until he was 18 years old, and he was able to have $100,000, about $100,000 he had access to, was absolutely amazing. But it didn't click in for me. For me, I'm just like, oh, rich kid, lucky guy. That's not my background. That's not where I come from. So we don't have the same struggles. Fast forward, I graduate college and I get into the insurance business. I get my license. I'm excited. I still have what he said to me in the back of my head with the cash value. He said, I just remember, yeah, it's cash value insurance, but I didn't really think too much of it. So as I went on, I started selling mortgage protection, right? I was on the phone dialing mortgage protection. Hey, need mortgage protection. I was targeting people who had mortgages in 2010. Obviously, this was a few years after the big bubble and the crash. And let's just say I didn't do extremely well at the time, and I fell off of the insurance space and selling mortgage protection. But something brought me back around to it. I was in a meeting and I got invited to a conference and I was speaking to a guy and he said, yeah, I utilize infinite banking, right? I don't, so he said he was buying a car for his son. And I was like, man, hopefully these loan rates aren't too high. And he said, look, man, I borrow against my policy, my life insurance policy. And again, when I was doing it, all I was selling was mortgage protection, or essentially it's term life insurance. Basically, you can get a term life policy for 10, 20, or 30 years. And term policy is the cheapest out of all life insurance. And so when you think of life insurance, you think about, hey, when you're dead, this is what I'm going to leave to my kids, to my family if something happens to me. But based on my experience, the truth is sometimes people are selfish. They're not thinking about when they're gone. They want to think about what does it look like when I'm alive? I don't have $1 million now. I don't have any kids. Who do I need to leave $1 million for? So when I thought about that and people telling me that, I was like, man, there's no real value in insurance for me. But when he spoke to me about that thing again, that cash value insurance, now I started to listen more. And he said, look, Mike, here's the truth, right? I put a lot of money into my life insurance policy because I want to always have access to the cash value. I get growth from it. Now, so let me explain what that looks like, right? So I want to give you an illustration here. He said, Mike, I have a policy, right? I have an IUL policy. So he has an IUL policy, right? And IUL stands for Index Universal Life. Index Universal Life, essentially, you have a couple different components. One, you have the insurance component, right? You have the insurance component, the death benefit. We'll call it that. It's the death benefit, right? So you have the death benefit. So let's say you have the death benefit aspect, right? The second thing you have cash accumulation. All right. What does that mean? So with IULs, what's unique about Index Universal Life policies is it follows the market. Typically, the S&P 500. The S&P 500 is basically a combination of the top 500 stocks in the US, and this basically shows what the market looks like, or how healthy the US economy is, right? So when you diversify into the stock market, typically on average, you can gain about 6%, right? You have up months, you have down months. What's unique about Index Universal Life, right? You can also receive living benefits, right? And I'll get to the living benefits piece in a second. But the cool part with IULs, or Index Universal Life insurance, and the cash accumulation piece is, like I said, it follows the market. So not only does it follow the market and you get the upside, but you're protected against the downside. Why is that, Mike? How can a policy put money into the stock market, but if it loses money, you don't lose money? It's because you're not actually in the market. What they do, they bet on options. So if the market goes up, you're able to benefit from that. But if it goes down, based on their option, they'll either come out of it or they'll win with the market going down. So what does that look like, right? So you have, we'll call it the market, and we'll have your policy. All right, so if the market goes up 6%, typically, based on the policy, you'll get 6%, right? The market goes up 8%, you'll get 8%. However, if the market goes down 15%, you're at 0%. Depending on the company, sometimes they have a floor of 1%. What does that mean? Typically, you'll end up with more money because you have this floor. Now, what's the downside of this? Just there's a floor of 0%, there's also a cap, right? So what does that mean? The market, the policy, right? So we have the 6%. 6% will give you 6, 8, 8. We have minus 15, right? 0. But say if the market goes up 13%, typically you're capped out. Most companies cap out at 10%. There are exceptions. There's some uncapped indexes, all of that. I want to just give you the standard of what it looks like. So what am I saying? I'm saying that the beautiful part about IULs in particular is that you'll still get the death benefit in case you pass. The cash accumulation, meaning whatever principal you have put in, whatever principal that's put in is 100% safe, right? You will never lose money on the principal you put in. So a lot of times people are putting money into policies that is within the guidelines of the tax law. They're funneling money into an insurance policy specifically because with insurance policies, one of the things you get, you can take out loans, and as loans are tax free, right? They're tax free. So if you're fronting or putting, say, for example, I have a policy, I want to put $10,000 into the policy, right? You're going to have the cost of the insurance. So the idea is to have a minimum death benefit, right? The lowest amount of your death benefit, and you want to have maximum cash value, right? You want to have maximum cash value. Why do you want to have maximum cash value? Because any gains that you get, the 8%, the 6%, the 10%, whatever gains that you get, say if you have gains on the 10 grand, right? And you get 10%. So now you're at 11 grand. You are able to pull the cash out in the form of a loan tax free. Typical loans on policies can range, right? It depends on the Fed rate, all of that, but I've seen anywhere between 4 to 6%, right, of your loan value. If you take out a loan, let's use 5% in the middle, right? Your loan rate. If your loan rate is 5%, but the market is giving you 8% back, whatever money you borrowed, if you decided to borrow your $10,000 hypothetically, you're paying $500 for interest, but you've also gained $800 from the market. So now your total is $300. Does that make sense? I want you to understand what people are doing now, and this is why it was so important for me to learn it, because I don't think we understand what this looks like. I didn't understand it. What the guy told me, he said, look, if I put my money in a bank, even if I put it in a high yield saving, I'm going to get 3%. If I put it in the stock market, there's nothing wrong with putting it in the stock market. But if I'm pulling out the money, I'm paying taxes on that, right? Whether that is taxed, whether you're getting tax deferred or you're paying taxes up front now. However, the money that I put into the market, I'm going to take out a loan on it. I'll pay the interest, which is typically cheaper than if I got a car loan, or if I'm getting if I got a typical car loan. I'd rather do that, gain interest on the money, because when you're taking out a loan, your money still sits because you're technically borrowing it from the insurance company. So although you're pulling $10,000, they use that as your collateral in your death benefit that you have. You're still gaining interest on your $10,000. Because you're still gaining interest on your $10,000, you're always coming out ahead. So he's basically paying for his bills, or paying for this car and paying it back while still accumulating money. That's the wealth game that people are playing. They're utilizing cash value life insurance, whether that is via index universal life or a whole life, to accumulate, to build wealth, to avoid paying taxes. Because look, although you're borrowing a loan, you don't necessarily have to pay it back. You want to make sure that you keep your policy active and you have enough cash in there, and you have your account, you have enough money in there, and your cash value, you don't surrender it. But as long as you have enough to pay the premiums, it will start to build on its own. I want to show you an illustration from a company so you can get an idea of what it looks like, because this is really important that you see this. I want to show you an illustration of what it looks like. Let me pull one up here. And I'm doing this live because I think this is extremely important when it comes to really understanding the benefits of life insurance. This is just a super basic illustration. This is very basic illustration. No riders, no blending, anything like that. But I want to give you an idea. All right, so I said I was going to show you an illustration. So I'm going to show you a very basic illustration, right? I didn't do any blending, but I want to give you an idea of what I mean and how people benefit from utilizing something like an index universal life policy, right? So I'm going to share my screen here. All right, so if you look at the screen here, where's my pen? See, my pen is not working. All right, so I'll just use the mouse until this pen decides to work. So if you look at the screen here, I want you to notice a few things here, right? So one, notice that this policy stops after year 7, right? A 7 pay. Most 95% of life insurance agents that you see that I know of that I've learned from, they'll do two things. They will tell you, you'll see them people paying premiums basically the entire time. So from the start of age, so just use my age at the time of this video, 38, up until sometimes they do it till 95, 65, up until then. I realized that when people cancel policies, they typically cancel it within the first 5 years. I wanted people to treat their policy and pay it up and never have to worry about it again. So I don't do any policies personally for more than 7 years. Most times I try to get it done within the first, honestly, within the first 5 years, depending on how much money a person wants to put in or how much money a person wants to front load into the policy. So that's the very first thing is my policies do not typically go past 7 years. Now, what do we notice? This person, again, hypothetical, they want to pay $25,000 annually per year. Remember, the average, and it could be lower, it could be higher. But for this illustration, they use 6.81%, the average interest that you will get on your money. So if you look at here, you see the premium outlay, $25,000 the person puts in, 22,840. So this is the money after the fees of paying for the policy. And this is the cash surrender value, the money that you'll be able to, if you want to cancel the policy, to withdraw, but you can borrow up to a certain amount as long as you have up to your accumulated value, as long as you have enough money to pay your premiums. I always suggest that you do not borrow everything, but you have access, depending on certain riders, to borrow sometimes up to 90, 95% of your money. So you look at first year, second year, you put in $50,000, accumulated value is 47,000. By year 5, when you have $125,000 in, notice your accumulated value is up 130,000 here. You still have the $373,000 of your death benefits in the event, God forbid, something happened. But notice again, remember I said this is a strategy people use. They're done after 7 years. They put no more than $175,000 in after 7 years. They never funded it again. And a lot of times people front load it, put money in. They never funded it again. By the time that they are 65 years old, they'll have over $700,000, almost $800,000 that they can use in terms of withdrawals and or if you need to pull out a loan. You have $1 million in death benefit. So you have the ability to create and to build, and all of this, your death benefit is tax-free. If you're withdrawal, if you need to pull money, you can pull out a loan up to what you have access to. And remember, I said you never have to pay it back, right? They'll start to pull it from the death benefit. So ideally, if you want to make a purchase, your money will still grow because whatever interest you are paying on it, the money that you make in the market will typically, most times, will either, based depending on the participating or the not or non-participating loan, again another video, you'll still be able to have access to the money. Does that make sense? I wanted to make sure that there was an understanding because A lot of people don't understand the value of life insurance because they only look at it as death. You only look at it as death. And let me share something. Remember, I said there's a few things, right? You have the ability for the living benefits. So if something happens, depending on the carrier, right? Some carriers give you Alzheimer's, you have a chronic illness, a critical illness, an accident. You're able to access some of that money so you don't have to come out of pocket. And or if you need to pull out a loan to pay off medical expenses, which is one of the reasons medical expenses are one of the top reasons that people file for bankruptcy. Not only that, some of the leading causes of divorce is financial issues, obviously, and infidelity, right? Why not secure your family in a way that makes sense, right? So this was something when I started to learn that I said, man, I have to teach this. Why? Because for me, right? And I'm just speaking about for me and my purpose. I want to be able to teach stuff that I was never taught. Typically, it's a class issue, right? It's not necessarily a racist, it's a class issue. So we don't have access to this. At what point do you learn this in school? Banks are insured. Why? Because there's value in insurance. And we insure our cars, we have to insure our homes. We don't insure our lives because we don't think about it after. But what if life insurance can be used as a benefit for banking, right? For paying your bills while still being able to accrue interest. Because if you take $10,000 out of a bank, you cannot accrue interest on that. But if you borrow from a life insurance policy, you're still able to accrue on that balance. Right? If you have any other questions, feel free to reach out. Check the link below, or you can send me a DM on Instagram or TikTok or wherever you're watching this. Leave a comment on YouTube. My goal is to really make sure that we understand it at a fundamental level, to use strategies to acquire and build wealth. Wealthy people, especially, utilize insurance on that. They borrow money, they keep their capital. I appreciate you guys. Take care.